Corporate finance practice problem using OneNote. Stock split 3-for-1 versus 2-for-1. Get ready. It's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, down in the 1827 Stock Split 3-for-1 and 2-for-1 tab. Also note, when using OneNote, look at the immersive reader. Our presentations will be down in the text area as well with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculation on down below, comparing and contrasting a 2-for-1 versus 3-for-1 stock split, something bit different than a stock dividend that we want to be keeping in mind. Information up top, we got the market price at the 110. We're going to be focusing in on the equity section as we look at the split, because given the fact that it is a split and there's no change to the assets or liabilities, the focus will be on the changes will happen in the equity section with regards to the balance sheet. Remember that the equity section represents, if looking at the accounting equation, which is the balance sheet, assets equal liabilities plus equity, or assets minus liabilities equals equity, meaning equity section is the owner's, shareholders being the owner's, claim to the assets of the company as opposed to the claim of the debtors or liabilities to the assets of the company. The total in the equity section is similar for any kind of business representing total owner claim in essence. However, we break that out differently based on the type of entity. This being a corporation, we're going to break out the information by basically the investments from the owners in the form of the common stock versus the earnings that have accumulated that have not yet been paid out, that being the retained earnings. Let's take a look at that in a bit more detail. So we got the information for the common stock. We have the shares that are outstanding, 2,000 shares at a par value of 10, remembering that 10 does not represent what we sold it for, or what basically the market value is. It's an arbitrary number, one that makes it easy for us to compare and contrast the total common stock and the shares, due to the fact that if we use the amount that we issued them for, that amount will change according to the market value if we have multiple issuances. So that 2,000 times the 10 going to give us the 20,000. The paid in capital in excess of par is 14,000. That represents the amount that we got from the owners, the shareholders, over and above the par value. That means that the 20,000 and the 14,000 represent the amount that was given to the company in basically investment. You can think about that as the money coming from the owners of the company, which are the shareholders. Does not necessarily mean that the current shareholders are the ones that gave us the money, because they might have sold the stock on the secondary market. But this represents money that comes from the owners, being the stockholders of the company. Then we have the retained earnings, which represents the earnings that have accumulated, things that flow through the income statement into the balance sheet, which has not yet been distributed back out to the owners, stockholders, in the form of dividends. If we take the 20,000, the 14,000, and the 43,000, we should get up to the 77,000 total equity. We have the stock split we're going to be focusing in on first, and we got the earnings, basically bottom line. We're thinking of the income statement at the 18,000. So you can kind of see it like a split pretty clearly just looking at the statement of stockholders' equity. So we'll do some calculations with it, and then we'll see it again. But the ending result would be just what you would expect it to be. We've got the 2,000 shares. If we split the stock, then, meaning every one stock now has two stocks, then we have 4,000 shares. Now, the thing with the split that's different than the dividend is that with the split, we're not imagining we're giving any more value to the stockholders. So there's no change to the retained earnings, because if you were a stockholder, you would have had one stock before, and now you have two stocks, but the value you would expect to be halved, given the fact that it's an even basically distribution or split that took place. So notice nothing's happening to retained earnings. Instead, we're just going to have the par value. So now we got the 4,000 shares, doubling it, but halving, dividing by 2, the 10 on the par value, which leaves us with 20,000 still. Again, no change to the paid in capital in excess of par, no change to the retained earnings, the total equity remaining the same at the 77,000. So if we want to see the calculations on that, quick look at the calculation. The number of shares was at the 2,000, and then we had 2 for 1, so now they're at 4,000. And the par value was at 10, dividing it by 2, we're down to 5 on the par value. That, of course, represented up top the 4,000 and the 5, once again leaving us at that same 77,000 for the total equity, no change from the starting point before the split took place, although there's twice as many shares out there at this point in time. The people that were holding those shares, however, also have twice as many shares. So now, what would happen if we had the same type of thing, but this time we want to think of a 3-for-1. I know it still says 2-for-1 here, but we're imagining 3-for-1 split this time. 3-for-1 split. It would do just what you would expect then. We're looking at the equity section would change. We had 2,000 before, 3 shares for every 1. 3 times the 2,000 gives us the 6,000 shares. We once again are not going to be changing the retained earnings. We're not imagining that the shareholders got any more value in this. They simply got a split that took place, and the value of the shares that they have would be reduced to reflect that, you would think, given the market change in accordance with the fact that we have done a split but haven't changed the underlying circumstances of the company. No change to assets and liabilities. So we would then just change the par value from 10 divided by 3 to about 3.33, and so on. Calculations on down below. We got the beginning 2,000 shares divided by times 3 for 6,000 shares. Then we took the par value divided by 3 to get to 3.33. The 6,000 times 3.33 gives us the same 20,000 here. No change to the paid-in capital in excess of par. No change to the retained earnings. Total equity remaining the same. Note this is a little bit easier than the stock dividend, where we do have kind of this difference that we would take place, and we would then say that there would be value that was given out to the company, to the owners, possibly reducing then the retained earnings for that and having an impact on the paid-in capital as well as the common stock. Well, now let's think about, what's going to happen to the earnings per share? And if we think about what happened here, we had the earnings per share starting point at the 18,000 at the earnings. We're going to imagine that to be the earnings of the company, basically bottom line of the income statement, in essence, net income. Number of shares we started at was 2,000 starting point for the shares. So the 18,000 divided by 2 will give us 9. So the earnings per share, 9. Then we had the 2-for-1 stock split, where we still have the earnings at the 18,000, but now we got 4,000 shares because there were 2,000 before. We did 2-for-1, so now times 2, 4,000. So 18,000 divided by 4,000 would mean that the shares are at 4.5. So notice on a per share basis, when we think about the equity section, you could think of it as the total equity section here, which did not change, which is the owners of the corporations. But then you got to think about it on a per share basis. On a per share basis, of course, it went down because there's more shares out there, even though the earnings basically remain the same here. So you would think that would be kind of bad for the shareholders. But when we look at the shareholders themselves, for every share that you owned, you would now have twice as many shares. And you would think then that, if you look at the earnings per share calculation, then the 2 shares that you now have, 4.5 would add up to 4.5 and 4.5, the 9 for where you stood beforehand. So it gets a little bit complicated to kind of figure this all out. You're like, okay, well, the total equity is the same for all of the owners, if I think of the owners as an aggregate, but the earnings per share is going to go down because there's twice as many shares. But if you look at an individual stockholder, if one guy had 1 share, one person had 1 share, now they got 2 shares, and the earnings per share for the 2 of them would be halved to 4.5, which would give us the same earning per share that we would have had before if they only had 1 when there was half as many stocks outstanding. What happened? Is it the same if we do the 3-for-1? Would we be in the same spot? We got the earnings at the 18,000. We got the shares at the 6,000. So 18,000 divided by 6,000 is going to give us the earnings per share of 3. So once again, there would be no change to the total equity for this last one. Total equity would be remaining the same as it was before. So you're thinking total ownership in aggregate the same, but now we have 6,000 shares instead of 2,000 shares. But that doesn't mean that we got 6,000 owners as opposed to 2,000. It means we have 6,000 units, kind of like currency. And if they haven't traded any of them yet, the same people have those 6,000 shares. So if I had 1 share before, and now then I would have 3 shares, and my 3 shares on the earnings per share are now worth $3 broken out, which if I add my 3 shares together would be $9, compared to before they did this, where I only had 1 share, but the earnings per share was, for that 1 share before they did the split, $9. So you should end up in kind of the same spot here. So then if we got the market price, the original 110 and the 2-for-1 split, you would expect then from the market standpoint, meaning the market price is driven, of course, by the market, but you would expect then the market to reflect what we did. What did we do? On the 2-for-1 stock split, we took the 2,000 shares and we doubled the amount of shares out there. We did not change the underlying conditions of the company. Assets, liabilities, the same. No change to the earnings. Therefore, you would think the market would reflect that by saying, oh, well, if the stock was 110 before, we're going to value the stocks at 55 now, given the fact that there's twice as many shares out there. If you have an accurate market that's reacting the way you would think would be a logical fashion, which generally the market does, unless there's some other things going on at the same time, that's what you would expect to happen in a market. On the 3-for-1, of course, if the shares were worth 110 before, and now you got 3 times as many shares out there, then you would think that the market price, the market would reflect the change in the price by taking that down, dividing it by 3 to the 36.67.